Okay, thank you everyone for tuning in today. We're doing market developments and investment banking with respect to the European debt crisis. Mainly, our group is Armin Yerkanyan, Tyler Raza, Rodney Mills, Ashley Davis, and Brock Jensen. So we'll get right in it, and we'll start with the IPO issuance in relationship to the European debt crisis. So clearly, IPOs are best issued in a bull market. That way, the companies are better able to get all the value out of their IPO issuances that they can. With the European debt crisis, along with other macroeconomic factors, the markets have been very volatile, and so it has been very difficult to time IPOs. And as a result, IPO issuance has suffered. We see internationally that IPO deals are down about 30% this year compared to last year, a deal size of 336 compared to 478. Proceeds were down a whopping 41%. There were 138 billion in proceeds. Compared to 235 billion last year, and the average deal size was down about 16%. In the United States, IPOs weren't hit as hard, although they were hit still. The average deal size was down about 16%. There were 125 U.S. IPOs in 2011, down from 154 in 2010, which is down about 19%. And interestingly, the proceeds were only down 6%. They were at 36.3 billion compared to 38.7 last year, and the deal size was actually up in the United States. It was up about 16%. And so we turn our attention now to debt financing, and we've chosen to focus in on the different nations in the Eurozone. We know that corporations there, if their respective governments are having trouble obtaining financing, then they'll probably have trouble obtaining it as well, because they're tied to their government and the regulations, and the budget, and is very tied to the economy in that nation. So we see here all of them are compared to the Bund and the U.S. Treasury bond, because those are generally the safe havens for investors, and they're the lowest. They're the instruments that investors flee to when times get tough. And so we see here Portugal at 14.53%. That's very, very high, but not quite as high as Greece, who's been the clear whipping boy of Europe. They're at 34.6%, which is 3,262 basis points above the German Bund, which is a pretty large spread. And what that says is that investors don't have a lot of confidence in Greece's credit. France also was downgraded, but we can see that they're not quite as bad off as many of the other nations there. So we'll move on now and see how the European debt crisis has affected mergers and acquisitions.
Innovations in the oil and gas industry have generated a boom in U.S. energy productions. Companies are supplying so much natural gas that prices have fallen to 10-year lows. Apache just purchased privately owned Cordillera Energy for $2.85 billion in cash and stock. The purchase grants the corporation 254,000 acres on the Texas-Oklahoma border known as Granite Walsh. Apache had recently been drilling here for 35 years, but sees new potential with recent advanced methods of recovering oil and natural gas. This deal highlights how new drilling techniques are changing the U.S. oil business. Pinsent Masons is reviewing a merger with McGregor's that would create a law firm valued at 300 million euros. In the past year, many law firms have merged. Therefore, this merger prospect doesn't really surprise anyone, and many other law firms are expected to follow suit because of dual pressure from both clients demanding more value for money, as well as an attempt to stabilize profitability. Tony Williams, the founder of Jamadi, said, "The only surprise is that it's taken so long." After approvals from other major U.S. regulatory agencies, on Wednesday, January 18th, the SEC approved the proposed merger of New York Stock Exchange Euronext and Deutsche Börse. Approvals are dependent upon the $17 billion combination closing planned. These two corporations account for an estimated 93% of business and exchange-traded derivatives. Analysts believe that there is a small chance that this merger will go through after European antitrust examiners recommended that commissioners block the deal on grounds that it would establish a monopoly in European-listed futures and options tradings. However, executives of these corporations are now preparing a lobbying effort to convince European policymakers that the deal will strengthen the region's and global markets. And now on to the economic conditions.
Alrighty, it's no secret that the current economic conditions in the European Union are not great. A few weeks back at the beginning of January, many countries in the Eurozone were downgraded from their AAA credit ratings, which will weaken their ability to acquire debt, and most of them will many borrowers in the country will have to pay higher interest rates because of that. Also, European governments announced last week that some countries are adopting more U.S.-style employment laws, which will make it easier for them to lay off and terminate employees, making their economy more lean and not having to pay the benefits and the pensions and things like that for so many years they have got themselves into paying. Easing up on those type of pensions plans and those type of benefits will definitely help the country during this weak time that they're going through. A series of negotiations and bailouts, just like we saw back during the economic recession here in the United States, have failed to stop the slide of investor confidence and restore the growth needed to give the struggling countries a way to get out of their debt traps. It's been really difficult for them during these times. One thing they've done to change regulation affecting securities is they have made new regulations affecting the way they do short sales and credit default swaps. And their fears are really based on three things. It's transparency deficiencies, risk of negative pricing spirals, and settlement risk associated with uncovered default swaps. Of course, whenever they make changes like this, it tends to make investing less risky, but at the same time, it can have a drastic effect on the amount of volume that's done. Last but not least, there's a tax development that has also been introduced into the Eurozone. Notional interest deduction is something that was put into the tax rule about 5 years ago, and it has recently been instituted into many countries there. It allows for corporate taxpayers to benefit from a tax deduction corresponding to a percentage of fictitious interest on their adjusted equity. Many large investment groups and many companies looking to finance will take on more debt because of the benefits that they receive from this new tax development. Next, we'll hear a little bit about the investment banking situation in the European debt crisis.
On January 13th, Standard & Poor's downgraded the credit ratings of France, Italy, and 7 other European countries as a reminder to investors that the European credit crisis is far from over. As the credit crisis heads into its third year, there are still no clear-cut solutions, although a new program by the European Central Bank might lighten the financial market pressures. Finance Minister of France, Francois Baron, said that although the downgrade was not good news, it wasn't a catastrophe. In addition to the European debt crisis, the Director of International Monetary Funds has come out and said that Europe needs a stronger financial firewall to stop the spread of debt in the Eurozone. European Central Bank policymaker José Manuel González Paramo has come out last Tuesday to say that it is unlikely that the Eurozone is going to slip into a deep recession. A surprise upspring in the Eurozone service sector this month has raised hopes of recovering in 2012, noting that a 1.6% growth rate for the Eurozone is not brilliant but not dramatically low. In recent news, Goldman Sachs has recently awarded its employees with their annual bonuses, with some employees calling it a bloodbath after Goldman profits fell 58% in the fourth quarter of 2011 compared to a year earlier. Though some second-year analysts received $40,000 to $56,000 bonuses, some bankers and traders learned that they had received zero. But Goldman isn't the only investment bank with shrinking bonuses. Morgan Stanley limited cash bonuses at $125,000 for both junior and senior level employees. Furthermore, the World Bank, a multinational organization that provides financial assistance to developing countries, has come out to warn investors on the risk of a global recession by slashing its 2012 growth forecast for both emerging and developing economies. An escalation of the crisis would spare no one, said Andrew Burns, who is the manager of global macroeconomics. However, the World Bank predicts that if the crisis doesn't worsen in Europe, then the global economy will grow at 2.5%.
Okay, now we're going on to a summary of global markets, and the commodities market is shrinking. Despite the plunging prices and soaring volatility, investors and traders reduced bets on 13 key commodity contracts, from crude oil to copper to cotton, by 19% in 2011. The mass departure was the biggest in at least 12 years, outpacing the flight seen in 2008 during the financial crisis. The collapse of the commodity trading firm Global Holdings in October 2011 likely contributed to the decline. And in November 2011, futures and options for copper fell 112,431 contracts. Cotton fell by 1,080, 303 contracts in November 2011. Foreign exchange markets as of January 27, 2012, the euro-US dollar spent the day consolidating after peaking at 1.3183 on January 26, 2012, and this decline is largely due to the Greek debt crisis. The US dollar-Japanese yen have sustained short-term stop losses below 77.00 after peaking at 78.27 2 days prior. The British pound sterling US dollar spiked to 1.5730 on the back of the weaker new home sales US market. The Australian dollar US dollar had a very positive climb thanks to expectations that US interest rates will stay close to zero mid-2014. Hedge funds. Third quarter 2011, 213 funds went out of business. That is the largest number of liquidations since the first quarter of 2010, when 240 funds closed. The European debt crisis and overall weak economy is making the hedge funds suffer. In fact, the third quarter of 2011 was one of the worst in history for hedge funds, with losses across almost every strategy. Losses were at 5.5%. That performance made third quarter of 2011 the fourth worst in the industry's history, following third quarter and fourth quarter 2008 and third quarter 2009. And that's the weekly update on what's going on in the investment banking world and the European Union.